Welcome to this series of educational presentations on structured products. I'm Rob Kingsbury and I'm talking to Ian Lowes, the founder of StructuredProductReview.com and Managing Director of Lowes Financial Management, about structured products, what they are, what they do, and how they can be used in client portfolios. Ian, if I'm investing for growth, give me an example of a typical growth product.
Right, okay. There is no real typical growth contract. And as I said, you can have structured products which are linked to commodities, emerging markets index, or whatever. But let's, for the sake of the question, we're going to stick to the FTSE 100 index. Investing for growth, we could use an auto call contract, which we'll discuss in a bit, but the standard growth contracts are either a digital contract, which might give you a gain if the market is above a certain point at the end of the investment period, or an accelerated participation or a super tracker. Now, the super tracker might, for example, give us, one of the very popular ones some time ago was 200% of the rise in the FTSE 100 index capped at 80%. Now, if that was just 100% in the rise in the index, that might be uncapped. If it was 400% of the rise in the index, it might be capped at 60%. So you see how you get these variations. Now, all of these may have capital at risk, which means that if the market falls, you won't suffer a loss unless it falls by more than 50%. I have to caveat that all this with if the bank goes bust, you're going to lose your capital. Now, that's just your standard your standard super tracker type contract. A digital contract will give you a fixed return at maturity, provided the index is above a certain point. So it might be, as long as the index is higher at the end of the 5 or 6 year period, it might give you a 60% or a 70% gain. If it's lower, it just returns your capital. Now that does these all put a point in the future when you are going to be measuring the index compared to the start of the contract. Sometimes that is averaged over a few days, sometimes it's averaged over a year. Now, shorter averaging is better than no averaging, but shorter averaging is also better than long averaging. So you might have a contract which will measure the index at the end based on 10 days. So you're not going to suffer from a sudden fall. Now, if you use one contract like this in isolation, you are putting all your bets on that final day, or that final 10 days or whatever it is. So again, they should be used in conjunction with others. Now, you can also have defensive growth contracts, which might give you a fixed return even if the market falls by, say, up to 20% over the term. And so there's a whole combination of these, and these are all on the website, so you can compare what's available. But what's available today is not necessarily going to be available in a month's time, because a lot of it depends on the funding rates in the banks and the pricing of the options behind the contracts. So today you might be able to get, for example, a contract which gives you a 60% return at the end of 5 years if the FTSE is higher, but in a month's time that could be 65% on a new version or 55% on a new version. So lots of different variations of growth contracts.
Okay. And you can get growth contracts that are deposits, capital protected, and capital at risk.
Yeah. Again, the higher the risk that you take, the higher the potential return, but of course the higher the risk you've taken. A deposit-based contract might, for example, give you 100% participation in the rise in the FTSE 100 index. It may not be capped, or it might give you, I'll give you a recent example of a deposit contract, 400% of any rise in the FTSE 100 index over 5 years, subject to a maximum interest payment at maturity of 40%. Now, if I was going to look for 400% of the rise in the index over a 5-year period, but put capital at risk, then that return could rise to something like 80%. And it just becomes a combination of using the risk and the reward. The capital protected contracts are going to be similar to deposits, but because it's not a deposit but a loan to the bank, you might be able to get 400% of the rise in the index capped at, say, 50%.
Okay. You mentioned auto calls there, and they're otherwise termed kick-out plans. What are they?
Right, it sounds a bit derogatory, kick out. These are investments which are designed to pay you a fixed return for each year that you've held it, typically a fixed return for each year that you've held it, and it will mature on the first anniversary that the underlying measurement is above the reference level. So let's give you an example of a contract that we invested in last month. The bank behind this was Santander UK, albeit we've seen these with HSBC, Barclays, Morgan Stanley and the like. This particular one, it would mature after 12 months if the FTSE was higher than where it was when it started. So let's just say it starts at 5,800. In a year's time, if the FTSE is above 5,800, the investment will mature, it will pay a 10.5% gain, and give you your capital back. That 10.5% currently subject to capital gains tax. So in the hands of many investors, they'll use their capital gains tax allowance. That will be tax-free. If the FTSE isn't higher than 5,800 in a year's time, it runs for another year. And again, if the FTSE is higher than 5,800 on the second anniversary, it will mature and it will pay 21%, 2 times 10.5. If it's not, it runs for 3 years, it adds another 10.5 simple on, and if not, 4 years, 5 years, 6 years. Now, if we get to the end of 6 years and it's higher and it hasn't been higher on the previous 5, well, we've had a pretty bad 6 years, but we'll get 6 times 10.5%. If it's lower, it will return our capital. Think about this in the context of whatever else you were invested in, unless it's lower by more than 50%, in which case this would track the index and give you an equivalent loss. Now, there's no dividends included in the FTSE 100 index, so again, when you're comparing it against alternatives, recognize the fact that if you're invested in a tracker fund, you're going to have some charges built into that tracker fund, but you're also potentially going to get dividends on the underlying investments. So for that particular contract, in order for you to suffer a loss, assuming that you hold it until its eventual maturity date, either the bank has to go bust, which means the rest of your portfolio is not going to be immune, or the FTSE has to be lower on the 1st, 2nd, 3rd, 4th, 5th, 6th anniversary and 50% lower at the end. Now, recognize again that if it's 49% lower, you're getting your capital back. That capital has been effectively eroded by inflation over that 6 years. But again, think about it in the context of wherever else you were invested, because if the market's 49% down and you're getting your capital back, you can then go and reinvest that element of your portfolio back in the market to benefit from the recovery. Now, don't use one of these in isolation. You can use a series of them and build a portfolio over the years.
Ian, a lot of people are looking for income from their investments. How can structured products provide an income stream for people?
Okay. First thing to make clear, one of the things that we make clear to our clients is that whilst people are looking for an income, what they actually need is a regular payment. And sometimes it is actually more tax efficient to be using growth investments with a view to taking capital from them to provide you with that income that you need. But that said, in answer to your question, there are a number of structured products which are designed to pay you an income throughout the term. That might involve, let's just keep a simple process, 7% income per annum for 5 years, capital returned at the end, provided the market hasn't fallen by 50% or more during the term. Now, you're obviously putting your capital at risk there in return to get that 7% income, and again, that needs to be considered in the context of alternative investments that pay income, that again, might put your capital at risk, but in a different way. So again, they become a complement to the rest of the portfolio. Now, there are a lot of variations on the theme here. You can have income contracts which are conditional upon the, let's say, the FTSE 100 index trading within a certain range. So you might get, instead of 7% income throughout the term, you might get 7.5% income for each year, provided the FTSE trades between, say, 3,500 and 7,500 points. And if it trades outside of that range, depending on the terms, it might be, in 1 week, it might be 1/52nd of that 7.5% income reduced because it was outside the range for that week. Or it might be that if it's outside the range in 1 quarter, you get no income from that quarter. So again, that increases your risk of not getting an income, so that might take the income to 7.75%, for example. So a lot of different variations on a theme here, but I think if you're going to invest in a contract which is going to give you an income, but that income is conditional, you need to be sure that you have other sources of income and you're not totally reliant upon it. Also, if you're investing for an income and you're putting your capital at risk, you need to appreciate that you are putting your capital at risk. And if at the end of 5 years that capital matures at a loss because the market's fallen by a certain amount, then you're going to have less to reinvest to produce an income thereafter. So again, it becomes part of a portfolio strategy.
Ian, thank you very much for your time.
Thanks, Rob. It's been a pleasure.